Before we start, the one thing I'll just do is remind you that everything we're going to look at today is in the financial planning videos, and in particular in the report text templates and preparing a report video. So I just wanted to remind you about that. So whatever we cover, you know, if you need to, you can go back and review it all. Could somebody just let me know that you can hear me okay?
Yes.
Yep. Okay, good. The other thing before we start is that I just want to remind you about Portfolio Builder, Presentation Builder, which gives you the ability to control the look and feel of reports. So just as an example, I have added a graphic to the cover page of the report. And of course, all the title colors and the look and feel of them and so on are all available for customization in Presentation Builder. One of the things that we added, and we'll be looking at this a little later, is that there are some graphics now in this new style of reports, particularly in the what we'll call the section divider pages. But those can all be customized so that the colors throughout the report can reflect your corporate colors, so you can get the look and feel that you want. So the first thing I thought we'd do is have a look at the full meal deal kind of plan. So the report approach that we've always taken in the past is available under what we call default. So these are the standard report settings. There is a major change under planning tactics. You'll see income taxes, education, assets, debt plan. And these features are now the same as in this new 3C style, which is what we're going to, of course, focus on today. So, first of all, generally speaking, you'll notice that any of these titles in the sections list that are in bold, these represent these section divider pages. So the idea is just to visually, for the client, make the report fairly easy to follow. A summary section followed by a section on their vision and financial starting point, then a section on what we call the financial gap. Are you accumulating enough wealth to have and do what you want in life? Then a section on the estate gap, and then finally a section on the emergency fund and protection planning gaps, mainly insurance, of course. When we scroll back up to the financial gap, this is where this whole new 3Cs theme comes in. So there's a little explanation of what it is, and then there's a section on reducing taxes, converting wealth, creating wealth, and then finally one on conserving wealth. So if we look at the reducing taxes section, for instance, you can see all of the different subsections. So as always, you're able to select sections and subsections that you want to include in a report. So what I want to do is talk about what you can do from the point of view of flexibility around including those sections and subsections that you want. So all you need to do is go through, select whatever it is you want, and then what you can do is you can click the Save button, give that template, section template, a name, and you can see I have one, sample.bwr, and then once I've selected or given it a name, it's then available for me at any time to go in and select it and load it in. One observation that I'll make about these section templates and the concept behind them is that you may be working, let's say, with a doctor. And so you want to keep the length of the report very short. You want to have it very graphical, something that's very easily understood. So the concept is you go in, select the sections and subsections that you want, save them as your doctor template, and then what you're able to do is the next time you're doing a report for a doctor, you just simply click the load button, select the doctor template, and then you'll load the sections and subsections that you want for your doctor. By the same token, there may be different sections and subsections you want for a business person. Maybe something that's got a little more content around tables, for instance, more numbers. So again, you just select the different sections and subsections, save them as a business person template. Coupled with the section templates are also text templates. And in order to try and lighten things up a little and make the features a little clearer for you, we added this options button, and if you click it, what you see is you can also create text templates. So you can see here I've got a number of them: doctors pre-retirement, doctors post-retirement, business person. So even though I may have many of the same sections and subsections selected in a report for a doctor as I would for a business person, maybe I want the text to be somewhat different, my generic doctor text. So in order to create a new text template, all you need to do is click the Add button and give it a name. And then that will be the template that's loaded for this plan. You can go through and edit the text in the plan, save it to this text template that you've created. So the next time you do a plan, you just load the text template. I also want you to notice this copy button, and you'll see here I have two text templates. It's one doctor's pre-retirement, one doctor's post-retirement. So much of the text that I want to use for doctors may be the same for all doctors, but in some of the sections, for instance, income assets, I may want to talk in terms of accumulating wealth to be used during retirement, whereas if I'm dealing with a doctor who's already retired, the text that I use may be one more about consuming the wealth that we've created during retirement. So I could go through, create a doctor's template, put in my general text that I want to use, and then I could copy it, create a doctor's post-retirement template, and then just edit a few of the sections just to change the text so that it was more appropriate for the doctor who's already retired. The other thing I'll just point out is, of course, you can include to-dos in the report, and you can select the number of years that you want to have the to-dos showing. Generally, my recommendation is that you don't go beyond a few years. Things that are 20 years in the future, who knows whether we'll do them or not. So my personal view is to-dos should be the more immediately controllable future. And the same thing with the vision list. It should be the more immediately controllable future. And what you will see in the report, by the way, is some sections and subsections, for instance, your vision, where you can put in a section called Other Wants. So in that, you can talk about things that might be 20 years down the road, for instance. So I wasn't able to mute the call for some reason, so everybody's on it. Does anybody have any questions that they'd like to ask at this point? So you can see for purposes of today that I've loaded the sample plan section template, sample plan text template. You'll also recall in our reports that there are a number of sections where there are comparisons that are done, where you might compare what we start off with, we call the initial vision, but of course you can name it anything you want, and then you can create new solutions and in those make changes. So you now have the ability to compare any two solutions in the report. And the advantage of this is that you may have done an initial report 5 years ago, and then you did your 2016 version. It's now 2017, so what you want to do is you want to compare your 2016 version of the plan with your 2017 version. If you don't want to use some of the compare features, then all you need to do is make both the baseline and the selected plan the same, and then some of those comparison features won't show up. So let's just open the plan up. It'll take a minute or two for this to load because not only assembling all the numbers into the different tables, but it's also loading all the custom text that I put in, for instance. And what we'll do when this is loaded is we'll just go through and look at a few of the features and how they come together, particularly this whole financial gap 3 C's concept. Any questions while this is loading?
Yeah, Michael Elseth here. I just have a quick question. I'm using the cloud extensively.
Yeah.
Is this, do I have to move from VisionWorks into the cloud to be able to have these reports pull up?
No.
It's already there then, eh?
Yeah. Anything that's on the workstation version is the same as the desktop version.
Okay, that's great. Thank you.
Okay. Anyone with any other questions?
There's numbers there.
So one of the things that I'll do today is I'll just go through some of the new features that we've added, and they are reasonably extensive, actually. And then a little later what we'll do is we'll actually look at retirement assessment plans, because it's we now have the ability to create a retirement assessment plan, still very quickly, but it actually looks like you put in a huge amount of effort. And I'm going to build a retirement assessment plan from scratch, so you'll be able to see how easy it is to do, and yet how, I hope, reasonably impressive the plan is. And of course, we stand by our belief that the quality of the plans is much better than is available in any other kind of retirement type plan. I'm just wondering if this is a little slow with join me and quite a few people on today, by the way. Hopefully it'll finish off in a second. There we go. There's some interesting new features in the tax area, which is one of the reasons why actually building a plan takes a little bit longer, because there are some relatively sophisticated tax calculations that go on in the background. And we'll look at those when we look at the retirement assessment plans.
Okay.
So let's have a look. So you'll recall this is the graphic I've chosen to use on the cover page and so on. But I just want to cycle through things very quickly, and we'll hit some high points. So this is one of those section dividers that I mentioned. So it just helps segment the plan into, chunks. So this is the summary section. You'll notice the ability to add some text if you wish, but when you print a plan, this does not display. It just displays summary. And again, as we look at in Presentation Builder, the colors that are used are ones that you can change so that they match your corporate colors. So there's an introduction section that talks about the different gaps. And of course, all text throughout the plan can always be edited. And you can save the changes to the current text template, for instance. And we'll have a look at that a little bit later. Plan parties, of course. And then there's this overview section. So you'll notice that it starts off with net worth and liabilities, but here we're comparing the initial vision plan with your plan solution, where obviously changes have been made. Now again, if you don't want to do comparisons, you just want to show the projection, you can compare your plan to your plan as we looked on the report page, and then you'd simply get a single bar. You wouldn't get the two being compared. Same thing applies with the projected retirement funding coverage and so on. So let's go through. We have the to-do list. I've got 5 years in here. This is a compare section. Again, if we're showing, the pre-change situation with the post-change situation. Another divider page. And then if we just scroll through to vision, you can see I've got 5 years of vision. In this particular plan, I've added some photographs. And then this is the other wants section. So this is where I went out and itemized things that they want to do, sometime into the future, and the things that were particularly important to them. I want to scroll through this very quickly. So here we have the concept of the 3 C's. And literally all planning boils down to converting wealth, which might, for instance, be downsizing a house, creating wealth, which in our industry we tend to focus on portfolio returns, but it can also be, for example, through career. And I always use that example when talking to financial advisors, because to a great extent, for you to achieve what you want in life, it's a function of how you build your business. And for many of our clients who are entrepreneurs and so on, that's also true. And then conserving wealth, of course, is, having some more of its stick. And one of the forms of conserving wealth is actually reducing income taxes. So we conserve wealth when we don't pay the government what we don't have to. So although it's a special form, it's actually first in the list. I'm hearing some feedback or background noise, something going in the background. I've been unable to mute, so if anybody's got some noise in their room, if you could try and tone that down. So once we have the 3C section, now we have a section on reducing taxes, and then those are specific tax tactics. And these are now all automated, and I'll be showing you these a little bit later. So, for example, Bill makes donations, but by transferring it to Sue, the tax credit, there's actually a tax savings of $1,900, an additional tax savings. And then there's the effect of splitting pension income, $14,000, the effect of splitting CPP. And again, we'll come back and look at this when we look at the retirement assessment plan. Converting wealth is a whole new section, and it relates to, for instance, downsizing a home or retirement. So what this shows is the year that they plan to sell the home, the condo that they plan to buy to replace it. It shows the net capital takeout, and then it shows the impact on the income assets forecast. And in a great many cases, this may be something that people intend to do, and it could lead to, quite a substantial impact on the sustainability of their income assets through their retirement. Creating wealth, of course, can be cash sources. So these are relatively standard. Also, of course, the investment policy statement. And you'll notice I've intentionally changed portfolios to ones where the client is charged a lesser amount in the way of an NER or fee, and we can see the annual savings that creates. So I've added some text to highlight that for clients. So again, I'm just going to go through. Conserving wealth has a whole new section, and what it shows is the current spending plan. So this is from the initial vision, and the proposed spending plan, what they've decided to change. And then related to this is now a table that shows current and proposed. So, for example, they weren't donating to charities, but now they are going to. They're going to join a health club. But one of the things that they intend to do is also cut down their restaurant expenses. So whatever plan you, or solution you start with, and then you create a new solution, make changes, what happens is that it's showing the before and after, so to speak. If we continue to go forward and look at some of the other functionality, we've added a whole section on debt. So what this shows is the total outstanding debt that people have, and then any prepayments for any liabilities that they intend to make, what interest is saved. In this case, it's not too much. And then a schedule of the prepayments of any liabilities for the different debt that they have outstanding. There's also a whole new section on education funding. And what this does is it takes all students in the plan and looks at total education costs for all students, plus all current available funds in, for instance, RESPs, and then indicates if there's any gap and, what percent that gap is. There is an identical section for this in the appendix where you can go in and actually select the individual students. So if you want to show the individual costs and asset accumulation to fund education, you can add it to the appendix. But in the main body of the plan, it just summarizes all students. There's also just a retirement funding. This is the same as in the overview section, and then it starts at retirement and shows whether or not people's retirement assets will last. And then there's a whole section of, are you on course or not? Will the income assets last? So there are graphs and tables. And then now we're into the new section on the estate gap, where we have a look at, wills and beneficiaries and so on. And then finally, the section on the emergency fund and protection planning gaps, and a breakdown of the emergency fund and any of the insurance sections that you've included. So that's a quick overview. Any comments or questions? So let's go to the retirement assessment plan, and as I mentioned, I'm going to build this one right from scratch. So I'm going to assume that the client has either sent you a completed questionnaire, or you may have completed it with or on behalf of the client. So you'll remember at this point, hopefully they've done most of the work, or perhaps your assistant. So all we need to do is click the Add button, say we're importing from a questionnaire. In this case, it's a retirement assessment. And I'm just going to call this Smith 0106 for today's date. And then all I need to do is locate that data file that the client sent us, open it up, enter a password, of course, to decrypt the data if they've included a password. And then what's going to happen is that the plan will now be populated with the parties that we imported and all the entries, of course, that were in the questionnaire. Things like their salary entry that was in the questionnaire, and you'll recall whatever they entered as their desired retirement date becomes the end date for the salary and so on. So we've started off with the initial vision. So this is merely what is in the questionnaire. Now, one of the things that you can do, but we've made this much more flexible, is that if you wish, you can do an immediate turnaround and send back a two-page what we call initial assessment plan. So the client sends you this information. They're curious, am I on track, not on track? And so you can do an initial assessment plan and then send it back to them right away. And it's just that quick two-page overview. So we'll just have a quick look at that just as a reminder. So it's got some text, as far as desired retirement ages and income and a forecast for their income assets. And again, to remind you, all this text can be edited by you. And then because this is pre-retirement and there's a shortfall, it offers some suggestions. So talks about converting assets or downsizing our home. The idea is to give them some options to think about. Now, one of the enhancements is that if I wish, I can deselect that initial assessment, and what I can do is I can load the retirement assessment template. And so it now has the different sections and subsections, and you can see there's much more flexibility now than there was before. There is virtually the same flexibility as a full meal deal plan. So if I go down to reducing taxes, there are a few, some sections we haven't included. In other words, we don't want to do something quite as extensive as a complete plan, but I still got lots of choice here. So I don't need to, create a new solution, make changes, etc. I could simply go in, take what they've given me, make the changes, and then create the plan. But what I'm going to do for today's purposes, because the initial assessment does have that big shortfall, is I'm going to go back to solutions. I'm going to create a new solution, and then I'm going to go in and very quickly make some changes so you can see how rapidly you can actually build one of these and have it be quite good quality. So I'm going to call this your plan. The first change that I want to make relates to vehicles. So you're all aware that we talk a great deal about the importance of modeling vehicles. Now, this isn't necessarily the case if your clients lease vehicles, because really it's just a monthly cost. It could be part of general expenses. But to the degree that they buy vehicles, the impact of vehicles can be quite substantial on the plan. So just to illustrate that, when this was imported, it's just assuming that they're replacing, according to what they indicated in the questionnaire, that they're replacing their vehicle every 5 years. Well, I think at this point we can say let's not throw in vehicles way out in time. So I'm actually going to drag the SUV back to replacing the last one at age 70. And I'm also going to indicate that they probably won't be driving that SUV after 2045. So you'll remember that by doing this, what we're also able to do is cut off all those vehicle expenses later in life. We're not assuming that they're still part of general expenses, and hence our strong belief that vehicle expenses should be itemized, and then we can see the impact on the plan. Then I'm going to go in and, I'm sorry, that was the car, I apologize. I'm going to go in and do the same thing with the sport utility. I'm going to get rid of the last few, and I'm going to again assume that maybe this one we drive to 2050. But which age, by the way, will be 90 and 85. So again, that will have had an impact on the plan. The other thing that I want to do is I want to downsize their home. This is a couple that wants to do a lot of traveling later in life. So I'm going to go in and indicate that they're going to sell their home, and I'm just going to use 2030 as a year. And of course, I could put in any months of the year. And you'll notice, by the way, that the home is not very expensive, so perhaps not representative of living in one of the major centers these days. And I'm going to add a condo and indicate that I'll buy that condo in 2030. It'll be my principal residence, and I think I'll just make this $300,000. So again, this is going to have an impact on the plan, but it's one of the things that they indicated they'd like to do. What I'm going to do also is I'm going to adjust the CPP start date for Sue. So the way the retirement assessment plans work is that they just automatically assume that when you begin your retirement that you also start to receive CPP, for instance. So in this case, I'm going to put this out a little later in life for Sue. And then the other thing that I want to do is I want to adjust the RIF start date for Bill and Sue. We're going to rely on our income assets beforehand. So again, I'm going to put this out to 71. So we're actually going to be drawing on the TFSA when Sue first retires, and then for the RIF for later in life. And then I'm going to do the same thing for Bill. And then the last thing or second last thing actually that I want to do is I'm going to reallocate their portfolios. So when I imported the return assumption for the portfolios, it wasn't very high, just 3%. So I'm going to reallocate this portfolio, and I'm going to use one of the built-in 4-strong portfolios just by way of illustration. So let's actually make it moderate core, and I'm going to apply that to all portfolios. And then I'm going to do the same thing for Sue. And then the final thing that I'm going to show you is this whole new tax optimization feature around tax credits and transferring income. I think we may still have a little bit of a shortfall here, but we could tinker with other things if we wished. So yes, we still got a bit of a shortfall, but we're pretty close. You might have to increase the return assumptions a bit, or have a look at the spending. So let's go to tactics, and let's look at taxes. And I want to speak about this transferring of tax credits and splitting of different types of pension income. Depending on what's being selected in the plan, whether they're donations or medical expenses or, CPP is applying, or there's the ability to split pension income. In this case, let's just assume those 4 possibilities. Then the number of iterations is actually 4 squared, so 16 iterations. But what's interesting about all of this is that they each affect the other. So it's not, although it may be logical to say we should split CPP and we should split pension income, that is actually not necessarily the case. So if we select Optimize, what will happen is the software is going to go through, do a calculation, and do those 16 iterations in order to conclude which are the best of these transfer or split tax tactics that should be applied in this particular plan. So it's going to go through and figure out exactly what the advantage is for the total tax impact. Any questions about this tax optimization?
So Michael, is that based on whatever draws you have set up from the RIF, for example? It's just using that amount. It's not changing who's drawing from what account?
No. So whatever you set up, it's going to go through and it's going to talk about, splitting pension income or CPP or whatever. So you can see in this particular case what it's actually saying, and it's not a large amount, but it's actually saying the optimum tax tactic is only to split pension income. So now,
Michael, it's Len speaking. If you have a desire to pull $2,000 of RIF income out of this each year once they turn 65 to get the pension credit, how can you set that up? Like, you've moved your age forward to 71, but is there any potential for partial withdrawals?
Sure, absolutely. So there are a couple of things that you can do. So this is a little different question, Glenn, than sort of, the new report style question, but I'm happy to answer it. If I go to retirement and retirement plans, and this would be the same for the, full VisionWorks plan, not just a retirement assessment, you can see auto withdrawals. So auto withdrawals says, if I have a need and I have money in an RRSP or a RIF, take the money out that is required virtually on a year-by-year basis to top up what we call the primary account. Think of it as my main bank account, in order that I have enough money in my bank account to meet my expenses that year. So what's happening is 1 year I might buy a car, every couple of years I might take a special vacation. So the needs I have are, greater in some years than in others. So auto withdrawals just goes through and says, take whatever I need out virtually year by year. And I could do that, from an earlier age, for instance. But what I can also do, if I wish, is I can go into tactics, and again, you can see withdrawals. And in this case, you note that it's an RRSP, so we're not, talking about riffing at this point. But if I don't want to use auto withdrawals, or if I want to make an RRSP withdrawal, what I'm able to do is turn off auto withdrawals, and then I can control what I want to withdraw every year. Or I could do RRSP withdrawals for a certain number of years up to when I RIF, for instance. Does that answer your question?
Yep, thanks a lot.
Okay. So let's go to the report.
Michael, can I ask a question?
Yeah.
Yeah, so when you do the tax optimization, it's my understanding that it doesn't take into account the splitting pension for OAS. So can I split pension first and then run optimization and keep the pension split or income splitting?
Say that again.
Well, sometimes you just want to split income so there's no OAS clawback.
Right.
And I don't think the optimization takes into account the taxes to minimize clawback.
No, yes, that's correct. Doesn't take into account the OAS.
So could I run the splitting first and then do optimization?
Well, optimization is going to...
I'm just thinking once you split income, then you still might want to see, who could, what's the best split for tax credits and things.
Yeah, but optimization is telling you how to split the income.
Yeah, but it doesn't help with the OAS clawback.
From bill to sue, for instance. So optimization would override something else. I think what you want to do is create two solutions. one where you go in and do whatever you want to do, and then another solution where you go in and apply optimization and see which is actually better.
Yeah, actually, what I wouldn't mind doing is minimize the OAS clawback and then optimize after that, just to see, where's the best place to get the credits and things. But anyway, leave it with me.
Yeah. So you'll see now with the retirement assessments, we have the retirement assessment section template, which is now automatically loaded, and also the retirement assessment text template. And again, this is for a pre-retirement person. So what we'll do is we'll just run this. It'll be a little quicker to run than the longer report. And we'll see what we can produce. So I just want you to notice that having loaded the data and then having gone through, made some changes, just fixing that end date for vehicles so they're not spending money when they're not going to be driving, or the model isn't spending money when they're not going to be driving. I downsized the house, which is one of the things they talked about, and I just made that adjustment to CPP, the RIF start date, reallocated portfolios, and then did the optimized tax. All of that, including my explanation and questions, might have taken at the most 20 minutes, I suspect, less. So getting the bare bones of the plan built is actually extremely fast, and the only time-consuming element to it would be the degree to which you would want to go in and then just customize the text for this particular client. So editing text can, just take some time, but then you're personalizing it for the client. And the thing that I most want to show you, and again, this is a longer retirement assessment report. You don't need to make it nearly this long, but I wanted to show you what we can deliver very rapidly to clients, and when they see it, I believe they'll look at it and their conclusion will be that you put in a great deal of work. So again, we have that divider section, the overview, so all the things that we looked at before, to-do list, compare section, vision, and again, this is a little different because this is a retirement assessment, so it's talking about the retirement income goals, et cetera. But you can see here we can also add other wants, so we can itemize vacations they want to take or replacing their cars or whatever it might be. The 3C section, the income taxes that we looked at before, and here you can see the reducing taxes and the pension income split shows up. Converting wealth, this is the house that we downsized in 2030. And the impact it had on the income assets forecast. Creating wealth, in this case, is about portfolios. And then if we go forward, conserving wealth is just showing their projected retirement income spending. And then retirement funding, we've already looked at that. And you'll recall that we haven't completely corrected that gap, but we went a long way with just a few changes. And then, whether or not the funds are going to last. And then summing up is the net cash flow forecast starting just in retirement, because that's the focus of a retirement plan, and an income assets forecast. That starts from today and runs forward because we want to see the build-up pre-retirement of the income assets, and then, the consumption of them during retirement. So again, let me just go back a bit and I'll remind you about editing text. All you need to do is click on the text, select edit, make any change you want to make, and then when you save that change, you save it to the text template. So those were the templates we built earlier, or that we looked at earlier, doctors pre-retirement, doctors post-retirement. So I can create default or generic text for pre-retirement doctors, and then whenever I'm doing plan for a doctor, I can just load my doctor section template. I can load my doctor pre-retirement text template. Notes that talk about the accumulation of assets. And then if I wish, once I've created my text template, what I can do is I can cycle through the plan and I can give the text another edit. But in this case, the second edit, you can see the text I entered. But in this case, if I do another edit, what I have the ability to do is just go in and save those changes for the current file, the current plan only. So this is where I'm customizing or personalizing the text for my particular client so that I'm not using generic text. This text talks about rental property. So if the doctor has non-registered portfolios, TFSAs, and RSPs, but no rental properties, obviously I can exclude that so it makes sense to the doctor. And then at any time I can restore my default text or the VisionWorks text. Questions about text editing? So this is where you'll spend a little more time building a plan, getting all the key elements in there. I think I've fairly clearly illustrated will not take very long. So what may take a little time is merely personalizing things for the client. But then the client's going to end up with what I believe will look like a pretty thorough plan, and yet it didn't take very long to do.
I'm on the phone.
Questions?
Yeah, Michael, it's Ed again. I just want to go back to that optimization on the taxes.
Yeah.
When you selected auto withdrawals from each spouse's RSP,
Yeah.
is that optimization going to affect what's coming from whose account, or is it just taking what it's already calculated and doing a split?
No, it's transferring, what it's doing is it's transferring so it's first of all, it's transferring tax credits for donations in medical because either can complete, and it's also splitting CPP benefits. So what I'm able to do on the tax return is I'm able to split benefits or split pension income amount. It's not changing where the income is coming from. It's merely doing a change for tax purposes. Maybe the best thing for us to do is just to go in and have a look at that. So if we go out to, let's use 2031, and we'll go to uses in the income tax return, what we see is that Sue would have her qualifying pension income, Bill would have his, but on the tax return, we're able to transfer some of Bill's qualifying pension income from Bill to Sue, but that's for tax purposes, not cash flow purposes.
Okay.
Right? Bill's withdrawing whatever he's withdrawing from his RIF, let's say. Sue's withdrawing whatever she's withdrawing from her RIF. But for tax purposes, we're actually able to transfer income in order to reduce taxes. It's not impacting their actual cash flows.
Does it look at the estate tax as well?
No. Well, actually, I shouldn't say no. That's not true. It's looking at total taxes. So it's looking at taxes over the course of the projection.
Okay.
Michael, just to finish the thought, in a retirement assessment plan, we're not including the final year, which is the estate year. And the reason is, in a retirement assessment, there can be a great deal of estate noise. and it's very related to the estate. So in a basic retirement assessment plan, we're not including the last year of their lives because of the estate noise. What we are doing is, or what you have the ability to do, is a retirement and estate assessment plan, which is one step up from a plain retirement assessment plan. And the retirement and estate assessment plan includes the terms of wills and also does the insurance analysis. So you can see in the retirement assessment that we're missing the estate and insurance tabs, and that the will page is not available in the navigation pane. So this is intended to be, am I going to be okay in retirement? Right? It's intended to be able to do a very quick, provide clients with a very quick answer. That's, you know, the ability to do these, other than whatever text editing you want to do, the ability to do these kinds of plans very efficiently. And then you have the ability, if you wish, literally through a click, to upgrade from a retirement assessment to a full VisionWorks plan.
Michael, it's Daryl. Just a quick follow-up to that. So is what you're saying then is the tax optimization has no influence on the plan whatsoever. It wouldn't change when you take your OAS or who's taking the RIF or whether you should take your TFSA first. It's simply going to optimize the cash flow structure.
It's optimizing taxes.
Right, but after it's not going to alter input.
Yeah, it's not changing cash flows. It's merely moving money around that can be moved around on the tax return.
Right, okay, gotcha.
Right? So if Bill's making charitable donations, but because they can be transferred to Sue, even though cash flow-wise he's making them, then he continues to make the charitable donations, but Sue, there may be greater benefit if Sue claims the donation credit. Even though she doesn't make charitable donations, he can actually transfer it to her.
Hey, Michael, I just comment. I think it does change input slightly. Like if you leave it right now the way it is, split pension, but if you run optimize, it's not going to split pension anymore. Is that right?
No, it's not changing somebody's pension. It's changing it for, it's not from a cash flow point of view. It's changing it from just the tax point of view, what we looked at, moving the splitting of pension income around. Now, it can, because you're saving taxes, it has a secondary impact. And the secondary impact is because I'm not paying as much in taxes. Now, in this case, it's not a great deal of difference, and primarily because we still have this big financial shortfall. But if we do make this change in taxes and we pay less in tax overall, then it can have a secondary impact, which means the value of our income assets, our non-registered portfolio, or the amount of money we need to take from our TFSA or RSP is less because we're paying less taxes. And because what we need to take out is less, then the returns that we earn can be more, right?
Yeah, but I'm just saying that if you run optimization right now and then went back and checked taxes, you wouldn't see the same pension split that you had, that we just looked at. And the only impact that might have is if you did the income splitting, so you didn't get the OAS clawback. Right, so if somebody thought they avoided the clawback, if you want optimization, you might not be avoiding it anymore. Is that right?
Well, that may be true, but then you can go to OAS and you can check what the impact is on the clawback.
Yeah.
But the other thing is, on the optimization, if you go in and make, you run a tax optimization and then you make some other changes, whatever they may be, when you go to do reports, and I think we did the optimization last, but when we go to do reports, a message will come up asking if you want to re-optimize taxes.
No. So you can go home if you want. I'll run my car.
Any other questions? Anybody have any other questions? So if I just go and reduce taxes once we've reached reduce general expenses, it builds life expectancy, for instance, and now I go to do reports, because I made a change since I optimized taxes, I'm now being asked, do I want to re-optimize?
So, Michael, you've got the split CPP as an optimized. Does it show us what years it's doing that in, or is it just like reality, a one-time election? Either you're in or you're out.
I'm not sure I'm clear on your question yet.
Like, to apply for CPP splitting, you have to send a form into the government, and they split at source with your CPP.
Right.
Does this optimization say it's going to be split for 2022 through 2028 and then not because it's not effective for those years, or is it just a...
Yes, it goes through literally year by year and figures out, whether something should be done in a particular year or not.
So is it really worth, like, to go and say, I want to opt out of CPP splitting once I'm 75? I don't think that is real.
No, it's not going to give you the choice of saying I'm going to do it to a certain age and then not after. It's figuring out, what the optimum is. So it's going to optimize it every year.
But I'm just saying a client can't necessarily elect in any particular year that they don't want to split it once they've requested it.
Well, in the plan, right? Or are you saying if a client has elected to split, once they make that election, that's that, like a one-time election?
Because that's the way it works, right? If the plan is calculating and saying it's not optimal in 2029, a client can't go back and opt out, I don't believe. So I'm just wondering, is it material on the CPP benefit split?
Okay. Well, I'll have to look into that. Good question. I'll have to look into it.
Thanks.
Any other questions?
Michael, Louisa here.
Yes.
I was wondering if you could go through the first part of your presentation again, just for those of us who couldn't hear you.
Yes, I don't know what happened. I don't understand why had you joined in by the internet phone option or by the telephone option?
Well, I tried via the internet at first, and then I tried via the phone number that came up on the screen, and the phone number just gave me music for the longest time until Jeremy indicated what phone number to call.
Oh, okay. All right. Sure, I'd be happy to. So if for those of you that have been on the call since the beginning, unless there are any other questions, then thank you very much for your time, and certainly provide us with any feedback. I'm going to be very curious to know if you try this new 3 C's approach to reports with a few clients to see whether they react favorably, whether they have all of the organization in their minds in a more logical and fairly simple way, which is, basically everything in the plan is, okay, first thing we should be doing is trying to reduce income taxes. Why pay the government if we don't have to? Converting wealth might be selling a business, downsizing a home, whatever. Requires no effort to do that in the sense of, for sale sign, but it can have a very big impact on the sustainability of income assets. Creating wealth, is largely going to be investment portfolios, and then conserving wealth spending. So whether or not that sort of organization and flow seems fairly understandable by clients, the progression through the report makes sense to them. So hopefully it will help demystify planning for a lot of clients and make it very straightforward, logical, understandable. That's what we're trying to achieve. So any feedback that you can give us based on clients' reactions, we'd appreciate it.